More on the market today. Let's bring in RBC head of U.S. equity strategy, Lori Calvasina. Lori, thanks so much for the time today. I'm sure you've been listening. Is what we're talking about why the equities are sort of looking past what would otherwise be disturbing macro data?
No, I think that, inflation more or less, right? The pressures are starting to build, but they're not out of hand yet. And maybe they won't be out of hand. But, I think that there's a lot that our economists expected that showed up in this report today. And on the jobless claims side, right, like we have seen, more uncertainty emerge about the labor market since we've had all these revisions since we had the latest NFP report. But I wouldn't say that it was necessarily jarring enough. Markets are still focused on Fed cuts right now. We've been hearing this for, probably like 5 or 6 months now. And we're getting closer to that point where they actually come into fruition. And look, I think, Carl, the other thing I would just add to the discussion you all had earlier, I spent some time, just sort of studying the relationship between inflation and equities, when we were sort of in the dog days of August and things were a little bit slower. And there are, conflicting sort of impulses here, right? Inflation tends to push PE multiples down. We're seeing the S&P. The gains here are slowing, right? It's creeping to these new highs. The PEs can't break out. So that all makes sense. But at the same time, we have seen over time that when inflation rises, equity allocations in households also rise. And so I think the market, there are some tailwinds and some headwinds here, and the market is managing to sort of pay a little bit more attention to the tailwinds right now.
So is it your best guess that the negative seasonality we often see in September and October doesn't assert itself this year?
I'm still worried about the seasonality because, while we may not have sort of hit that tipping point on the labor side yet, I do think that we got to these highs with investors really having in the back of their minds that there wouldn't be, sort of ripple effects from all the policy disruption that we had earlier in the year. And, I think Mike Santoli said it well in one of his columns, right, when he said the market wants the cuts, but it doesn't need to want the cuts. And I thought that was just sort of a brilliant line, sort of capturing what I have been hearing in recent months. And I think we're getting to the point where, it does look like we need the cuts after all. And I think there's going to have to be some consideration and thought given to that when you're sitting at these peak valuation levels.
So, there's some that say buy the rumor, sell the fact when it comes to the Fed. It's all baked in now. We're expecting a cut next week, a few cuts for the rest of the year, and more coming next year.
No, and, we've heard that as well. I was talking to some investors yesterday, and we were sort of debating, like, where do you think that terminal is going to be next year? Has that really changed in people's minds? Like, maybe you've pulled forward the pace of some of those cuts, right? Maybe you've pulled forward when the launching point is for this next cutting cycle, if we can call it that. And, I will tell you, Sarah, when I've kind of thought back to my conversations with equity investors over the last few months, they hadn't been so focused, on exactly when you got those cuts. But cuts were always factored in to kind of the late 2025 and 2026 outlook. So I think that, you are getting a lot of what was expected, and that's certainly a positive development. But you do have to sort of look at stocks where they are and say, is a lot of this already baked in already? And I think a lot of it is.
Lori, really interesting picture developing, and it's going to be an interesting chase into the year end. We'll see what happens. Lori, thanks. Lori Calvasina.